Investors are looking to earnings season for bright spots amid a confluence of risk factors. Bank results generally held up thanks to higher rates, but the backdrop remains uncertain. Historically, October is the most volatile month for the S&P 500. So far this month, a lot of that turmoil has been in the Treasury market. Where the S&P is concerned, 4,200 is often cited as the next key level on the downside. Well, the big question right now is, have stocks been oversold, and is there a buying opportunity amid sustained risks? Joining us now is Keith Lerner. He's Truist Co-Chief Investment Officer. Keith, it's good to see you here. So we were just talking about the rising tensions in the Middle East when we talk about the geopolitical risk that is presented right now to the markets. You also have the surge right now in yields. What's, from your view, the biggest threat to equities at this point?
Yeah, well, Seana, great to be with you and Brad again. It's been a little bit. So going to the equity markets, you talked about the tensions. We're using the word cross currents right now. I do think, as far as you think about what's happening, the equity market has been very resilient in spite of everything that's happened here recently. So as far as the main risk, I think it's two things. When you have something like this build up as far as geopolitical tensions, you have to say, what is this going to do to the global economy, and how does this manifest itself into oil prices? So I think, oil prices, as you talked about earlier, have rebounded off the lows, but they're actually below where they were as far as the highs just before the conflict. So I think that's something to keep an eye on. And then this 10-year Treasury, which normally during geopolitical times of tension, you see somewhat of a pullback, you're pressing against the cycle highs again for the 10 years. So those are the two risk factors that we're keeping a close eye on.
And so with regard to that, has that kind of triggered any major repositioning at this time, Keith, for what you're advising, what you're kind of looking across some of the broader asset classes and deciding that even with some of the risks that you've mentioned a moment ago here, that there should be some type of reallocation that investors think about?
Yeah, it's a great question, Brad. We haven't made any changes recently. Our big picture, because of all this cross currents, is our main call is we're strongly neutral across asset classes as far as stocks, bonds, and cash. And that doesn't sound as far as a big call, but in this environment we have a lot of back and forth. We think it makes sense. Coming into October, though, what we had told our clients, we still think we're in this choppy range for the S&P, around 4,200 on the downside, about 4,600 on the upside. The good news is we came into October the most oversold or stretched to the downside since fall. So some of the bad news has been reflected. And the other thing that I think where we can actually push a bit higher towards the top end of that range, even with all these tensions, is the earnings season. I think the earnings season is going to be solid. If you look at things like the Atlanta GDP now, that's around 5%. That may overstate the case, but still the economy has been somewhat resilient. Jobs over the last quarter have averaged above 200,000. So I think we'll see that reflected as we get deeper into this earnings season. And
talking about earnings season.
I'm sorry, go ahead, Seana. No, I was going to say, if you wanted me to go more into how we're positioned within the equities, I can do that, but you let me know where you want to go next.
Okay, so we will get to that in a second, but I want to follow up quickly on earnings because so far we've heard from a number of the big banks. You take a look at their underperformance relative to the S&P more recently. I guess, what does that signal to you just in terms of how banks specifically are positioned and whether or not they're on much stronger footing than investors are giving them credit for at this point?
Yeah, I think overall the earnings for the big banks, it's been bifurcated, but so far they've been fine relative to expectations. But here's the notable thing about financials and banks. Historically, as you come out of a low, they tend to be leadership, like early cycle. Banks are since October of last year, where the market's up over 20%, are flat to down. So I would say banks, in our view, are just not the leadership group of this market. They haven't been the leadership. I think the best thing you can say is that valuations are compressed. There's a lot of bad news priced in, and earnings with those high interest rates have actually held in there fine. But again, I don't expect them to be leadership, nor do I think they need to be leadership for this market to grind a little bit higher.
And so, Keith, just coming back to that positioning that you were mentioning a moment ago, with all the factors at play during this earnings season, is there a theme that you expect to emerge that would kind of trigger some type of thought about which sectors investors should be weighted in the most?
Yeah, well, the first thing, even from a high level, as we think about global asset allocation with the geopolitical tensions, we've been Team USA for some time. All that's happening overseas reinforces that. And the one thing this time, too, the higher oil prices impacts consumers, but we also produce a lot of energy. That's a lot different than the 70s. So on a sector level, one of the areas that we still like and have been overweight for several months is the energy sector. It's one of the cheapest sectors in the market. Even if energy prices don't move a lot higher, as long as they stay somewhat stable, I think you'll see earning trends continue to move higher, and the companies are generating just a huge amount of cash flow. And then the other sector that we've been positive and remain positive on is the industrial sector. Part of that is the defense sector. We think there's going to be continued spending because of all these geopolitical tensions, especially as we move next year into an election year and we have a strategic battle with China even before this, and you put what's happening in the Middle East on top of that. We think those are two areas to stay overweight during this period of uncertainty.
Keith, just very quickly, I'm so glad you mentioned China because they did have Q3 GDP growth that really showed some type of rebound or recovery that is emerging here after the country had been talking about more stimulus that they needed to put into place, more projects that they needed to help fund for the next wave of investment coming from the nation into some of its core sectors here. For the companies that we're watching over the course of this earnings season that have the most international exposure, what can we expect for what they're going to say about China and how that's contributing to their business?
You know, the thing with China today, their stimulus is a lot different than it was the last decade. It's more based on the consumer and less on the industrial side. So I think you'll probably see that bifurcation. I will say more broadly, we've been very negative on emerging markets, zero allocation over the last year in our portfolios that we manage directly. And even though China's trying to do these stimulus things and it's being up, maybe it gets a bounce. The issues right now is that corporate profitability is moving down. Like the earning trends relative to the U.S. is much weaker. And there's still a lot of regulatory actions and so forth. So our view is we would still be negative on China, even though it could have a bounce. And those companies, I think what you're going to see more and more within the S&P, companies are going to continue to diversify outside of China, specifically to other regions to mitigate some of the this battle that we're seeing as far as between the geopolitical tensions and so forth.
Keith, always great to get some of your insights here, and thanks for joining us this morning to kick off the show ahead of the opening cross here. Keith Lerner, Truist Co-Chief Investment Officer. Appreciate it.
Thanks, guys.